Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. I am your host, as always, Dave Zaegel, and today's episode is again sponsored by CWOs for Hire, which is the retirement planning company that I co-own, where we focus on helping retirees and those soon who are going to be retired plan out their retirement and get the most out of their money and also not get killed in taxes. So we love helping people. If you need help, please reach out to us. You can find us at cwosforhire.com. We are wrapping up our series on investments specifically. We've already done 2 episodes. We're going to do a third here, highlighting important things to understand about investing, especially investing in individual companies. And in the previous 2 episodes, we've highlighted the need for planning first and investments second, because that investment management is good, but not without the proper planning first, in that we use a restaurant as an example where you can have the most amazing food in the whole world, but if you can't run the operations of the restaurant properly, you're not likely to going to be in business too long. So same idea happens with your retirement planning. If you don't have things planned properly in terms of structuring the investments, understanding tax planning, knowing what your retirement income guardrails are, all the stuff that we talk about all the time, if you don't have that in place, the most amazing investments in the world aren't going to help you quite as much. So first, get the planning down, then focus on the investments. But if you're going to be making investments, especially in individual companies, it's important to, 1, understand management, like we've already talked about, by listening to quarterly earnings calls, understanding management's background, not knowing every single detail about them, but listen to the company, invest that time to understand what they are doing and really dive a little bit deeper into their operations just by listening to their earnings calls. So you don't have to actually sit down with an Excel sheet and do all this analysis. You just need to take the time, 30 minutes, 45 minutes, 60 minutes, however long that recorded conference call is, and just listen. That's it. Just listen to what they are saying and understand what management is doing and who they are. Second thing we talked about was that balance sheets matter. You need to have a strong balance sheet in order to feel a little safer in the investments. You can invest in a company that doesn't have a good balance sheet. You just have to understand what the risks and opportunities are there. The third thing we want to cover is the third financial statement that we talked about on our last episode, which is the cash flow statement, because the cash flow statement absolutely matters. Well, you always hear cash is king. The other thing is that cash doesn't lie. If it does lie, somebody's committed fraud, and that's a whole different deal. But cash doesn't lie. On a cash flow statement, you have a couple of different parts, but at the very bottom, you're going to see a beginning cash, a changing cash, and an ending cash. Those can't lie unless they're fraud, all right? So the nice thing about that is that it really, really tells you, is the company making money or not? And most people think, well, the income statement tells you that. Not entirely. There's a lot of stuff that winds up on the income statement that's not cash immediately. It might have been previous cash, it might be future cash, but it's not necessarily cash in that period. For example, you could have depreciation and amortization expense. All that means is, let's say you bought a piece of equipment and you're going to depreciate it over 5 years. Well, the cash part happened previously. Now you're getting a depreciation amount, which is a non-cash item. Same idea with, you could have different accruals. So this is getting a little deeper into accounting, but sometimes you can have accrued expenses, meaning that maybe you've booked a liability on the balance sheet. And you say, we know that we are going to owe this amount. We're going to pay it at some future point in time, but we're recording the expense now because we're actually incurring the expense now. Even if we're not paying it now, we're incurring the expense now. So you can have a lot of different pieces on the income statement that are not directly tied to cash. The cash flow statement shows you all those pieces. So the very top of the cash flow statement is the cash flow from operations, where it starts with net income. It will take out non-cash items like depreciation that we already talked about, and several other non-cash items, maybe stock compensation, things like that. And then it will go through changes in the balance sheet. So changes in the assets, changes in the liabilities, and how those benefited or hurt the cash position. For example, if your accounts receivable went up, that's not necessarily by itself a good or bad thing, but it's a negative to the cash flow because that's less cash that you received in that period of time. And so I say it's not necessarily a good or bad thing, because if accounts receivable went up, that could be okay if your sales also went up. Now, if sales go down or are flat and your accounts receivable are up, now we got a little bit of a problem, but it could just also be a timing issue around that end of the quarter, end of the month, end of the year. So that's not necessarily good or bad. It's just important to note that in that top section, you get cash flow from operations. And that is a huge thing to focus on. Because if you see a negative number in there, you should be scratching your head and saying, why is cash negative for operations? Because it's not cash from financing or anything else that we're going to talk about. This is just purely operating the company on a regular basis. Is cash positive or is cash negative? So definitely key in on that part of the cash flow statement to understand how the company is doing. Where's the cash going? The other two pieces are cash from investing and cash from financing. Cash from investing activities it really just is what it says it is. So if you think about investing in pieces of equipment, like we talked about earlier, so if a company buys some big machines to operate their business, that's going to go in the cash flow from investment activities. The business itself could have its own investment account, and you're going to see gains or losses from those investments. The investment could be that they purchased another company, or now they have a subsidiary, and so they made a cash investment for that purchase. So that's going to be all the what I would call the major items where they have a pretty big expense, but it's considered an investment in the company to try to generate future earnings. So you may see, positive cash flow from operations, which is great. And you may see a negative cash flow from investments, which by itself is not necessarily good or bad. It's just a matter of, is it in proportion with how the company is doing overall? Should they be making that investment or not? That's up to management to decide and for us to evaluate as investors also. Then the last piece is cash flow from financing activities. So this is where if you're paying off debt, it's a negative to the cash flow. It's good to get the debt paid off generally, but it's a negative to the cash flow because you spent that cash to pay off debt. Similarly, if you get some debt, if you put a loan out there, you're going to receive the benefit of the cash from that financing activity. That's going to be a positive. In there, you'll also see dividend payments out. You'll also see any changes in equity. That's all going in that financing activity at the bottom. So it's important to understand you have cash flow from operations, cash flow from investing activities, cash flow from financing activities. And as I mentioned before, at the bottom, you will see beginning cash, changing cash, ending cash. That can't lie. That's cash. I'll use an example that I loved from many, many years ago, Salesforce.com. So for this, you have to picture a much younger Salesforce. We're talking over a decade ago. I was, at the time, I had a blog where I talked about different stocks. I'm pretty sure it's not existent anymore. I don't even know where to find it. It was fun to do when I became a financial advisor where I was working at the time did not allow me to have that blog any longer, so it got shut down. But I would go and blog about investing in different stocks. And one of the things that I love talking about all the time, and I love debating with people, was about Salesforce.com. because at the time, again, it was very much smaller company, kind of up and coming. It was a public company, so still had a decent size to it. But one of the things I would constantly hear as a criticism of Salesforce is, how can you invest in them? They don't make money. And I had to laugh every time because they did make money. What you had to understand is that everybody else was busy looking at the income statement to see if they made money. I was looking at the cash flow statement, and I could see that they were making plenty of money. Now, what was the difference? Well, this is going to get a little bit into some details on accounting, but what they have to do when they're recording their accounting is they have to defer a lot of their revenue and some of the cost of sales that go along with it. In their contracts, if they sign up a new customer, I'm just going to use a generic example. If they sign up a customer for a 3-year contract, so they go into a big company, they say, we're going to implement Salesforce. You're going to sign up for 3 years. We'll bill you annually or monthly, however they want to bill that. But then there's also going to be an implementation piece. And that implementation piece can be quite costly for their customers. So Salesforce is making a good chunk of money on that implementation, as they should. So what's interesting is that when you have this type of structure, all of that money and that cost of implementation, they don't get to recognize that on their income statement right away. They actually have to defer that over the life of the contract. So if you think about the income statement, they've made this big chunk of money from implementation, and they have all their other expenses of running the business. But because of how the accounting for this works, they don't get to show any of that implementation income right away, but yet they have all these expenses of running the business. So if you look just at the income statement, you go, oh man, income statement's negative. They're losing money. No. They've in fact already collected that money. It's just not going to show up on the income statement until it gets strung out over the course of whatever the contract is. So if you're focused just on the income statement, you'd miss the fact that they're actually doing phenomenally well. If you look at the cash flow statement, you can see, wow, cash flow from operations is great. And now they have on there a deferred revenue piece. I can't remember what terminology they use. It might be deferred bookings. You hear unearned revenue, deferred revenue, unearned bookings, things like that. It's all the same thing. It's where you have received the cash, but you are not allowed yet to recognize the revenue for that, or perhaps you haven't even delivered the service for it yet. So that's a fantastic example where a lot of the people were looking at the income statement and the net loss and saying, they don't make money. Why would you invest in them? That's ridiculous. It's not ridiculous at all. You had to go look at the cash flow statement to understand that they were doing phenomenally well and they're growing really, really well on top of that. And it was a great investment at the time, as shown in their stock price over the past decade plus. So that is just an example that I use that I'm very familiar with from history, to where if you're not looking at the cash flow statement, you're really missing out on a key piece, because that cash doesn't lie. Again, if it does lie, that's fraud, whole different story. But cash is cash. You can't finagle it. You can't make it look any different. They reconcile it all the time. The auditors are looking at that as step number one. Cash is cash. So if you want to know, is the company making money? Don't look so much at the income statement. Look at the cash flow statement. Cash flow statements matter.